Bob Iaccino, founder, chief strategist of Path Trading Partners, joins us to talk markets here. Bob, welcome. I want to begin with crude and the move up. We're seeing to 88 in the WTI, the Brent to 91 to begin the week. How concerned should we be?
Well, I guess it depends on what your concern is. If you're talking about the effect of crude oil specifically on inflation, it's actually a bit muted when you look at the input of energy and the amount of spend in your average consumer household on gasoline specifically. It's starting to put a little bit of pressure on the airline industry. You're starting to see fares creep up. So you could see a little bit of slowing travel, and you might even have a little bit of travel fatigue. So that might be okay from the consumer standpoint. But the problem we have with crude oil prices generally and gasoline prices specifically is you're talking about more of a psychological inflation bleeding into people's spending and potentially slowing the economy in a way that the Fed may not have anticipated when they were trying to slow the economy and trying to slow growth. When you look at crude oil again and gasoline, specifically any energy prices in general, you start to see people's their sort of bill at the pump go up by 10, 20, even 30%. And they start to pull back spending elsewhere, thinking that it's a larger part of their budget than it actually is for most households. So it ends up slowing spending overall and slowing the economy. So I think there's a concern to it, especially given where rates are now.
So crude oil higher, and maybe I like this in many ways in a counterintuitive fashion, right? Not necessarily considering, as you pointed out, too little impact on the consumer, right? On a daily basis, we're talking a matter of, tens of twenties of dollars on a weekly, monthly basis here. But to your point here, with the Fed in this initiative to slow the economy down, crude oil prices could slow the economy down as well, creating a scenario where the Fed does too much or goes too fast ultimately.
Well, that's the wild card in it, is when you look at one of the places that crude oil affects quite a bit is the manufacturing sector. And the manufacturing sector, if you judge by any of the PMI figures we got, whether it's ISM or S&P Global, you're seeing manufacturing in contraction. When you look at, for example, the payrolls number that we've got about 4 consecutive months of manufacturing payroll shrinking. On the headline number, every number over the last 6 months has been revised lower when it comes in the next month. So you're starting to see slowing in the general economy anyway, and that manufacturing sector tends to be the canary in the coal mine. Yes, we're a services economy, but the manufacturing sector still drives a lot of it. It's still, for lack of a better word, the engine of the overall economy, even though it's a smaller portion of it. And you start to raise costs there along with some of the labor costs we've seen. You take a company like UPS, for example, with the raise they just gave out in order to avert that strike that was threatened. And then you start adding 10, 20, 30% to their fuel costs. That has a big drag overall. It increases prices at the consumer level and then further slows the consumer spending. But it's that gasoline part that affects the consumer psyche, right? They start paying more at the gas pump. They start ordering less. UPS has less of a problem in terms of their gas bill as on a company-wide basis. They just start getting fewer and fewer deliveries. Emptier and emptier trucks.
Yeah, definitely a complex discussion here and a widespread ripple effect, to say the least. Here, I said too far, too much, too fast here. Ultimately, I guess the real question is, have they gone too far then, considering some of the slowing that we've already seen here? Let's talk real quick, and probably not the major focal point considering what's going on with crude. And to your point, the fact that rates are still at these stubbornly elevated levels as well, which we can get into in just a second. But the numbers here out this morning, we've got imports, we've got exports here in the U.S., international trade data coming out, and the trade balance here, Bob, the takeaway being that it looks like it's widened further than expected to minus 65 billion here.
Yeah, and I think you would expect these types of surprises in import-export numbers when you literally have, I hate this phrase because it's so overused, but it's perfect. The U.S. is kind of the best house on a deteriorating block in terms of economies. You know, you've got the UK, for example, and to a certain degree the EU as well, struggling with still way too high inflation comparative to the US, and slower economies, or economies that haven't quite gotten to the level of the US in the first place when that inflation was driving higher. So you would expect that to happen. And China is China's almost nowhere to be found in terms of the economic conversation. The spread between Western GDP and sort of the Pacific Rim GDP has been widening basically since 2022. So you would expect this direction if there was going to be a surprise in this particular set of numbers. You would expect it to be in this direction.
Bob, with the Bank of Canada's decision headed our way here a bit later this morning, energy prices on the rise here. Obviously, a lot of focus on the impact this could have on the ECB, the UK's Bank of England as well. Not necessarily what Europe wants to see as we head into the fall this winter. They managed to avoid a catastrophic situation last year. Talk to us about where this puts them right now. Speaking of a higher rate environment, it's not just here in the U.S. I mean, this is kind of a double-edged sword, a 1-2 gut punch in many ways for what they have headed into this decision in September and later this year, for that matter, for their economy.
Yeah, I suspect they're going to have to basically flat out halt, especially, again, given what's going on with crude prices. If crude prices rise, the demand will slow, and that will hurt Canada's economy. You know, it's interesting when you look at some of these commodity-based economies and commodity-based currencies, you look at sort of the divergence. Let's take the Aussie and New Zealand as a proxy for the Canadian dollar. They were both down around 1% or more against the US dollar yesterday. And today they get a little bit of relief, and it's not even 0.1%, or I should say not even 0.2% in the case of the Aussie. So you're talking about the commodity-based currencies really struggling. New Zealand and Australia with China, and Canada with the price of crude oil will help in terms of the deficit balance for their economy as they're selling crude oil. But then as the demand drops off, which inevitably happens with these higher prices, the reverse happens. So I suspect it puts them in a real situation where, their inflation levels aren't as concerning as the ECB and specifically the UK, but they are probably in a position now with the rising crude oil prices that they probably have to slow down or stop.
Well, we're going to talk a little bit about that correlation between crude prices and the Canadian dollar and the breakdown we've seen as of recent. So I like the precursor to that there as well, Bob, and the solid breakdown in terms of this discussion, crude prices here, and what it means for central bankers globally, as well as some of the currencies and other products we watch. There's a widespread ripple effect here, that's for sure. Bob Iaccino joining us this morning, the founder, the chief strategist of Path Trading Partners. Again, talking crude prices and the impact $88 the WTI has.